What is the Triffin dilemma in global monetary policy? Imagine a country whose money is used all around the world for trade and savings. That country faces a tricky balancing act that can affect the entire global economy. This is what the Triffin dilemma is all about. It happens when the main reserve currency country needs to supply enough of its money to keep international trade flowing smoothly. To do this, it often has to run trade deficits, meaning it imports more than it exports. This extra money helps other countries hold reserves and pay for international trade. But there is a catch. Running these deficits over time can make people lose confidence in that country's currency. If trust drops, the currency might lose its reserve status, which is very important for global stability. This problem was most clear when the United States used the dollar as the main reserve currency under the Bretton Woods system. Back then, the dollar could be exchanged for gold at a fixed rate. The United States had to keep supplying dollars to the world by running deficits. But if it kept doing that for too long, it risked running out of gold reserves. If the United States stopped running deficits, the global supply of dollars would shrink, hurting international trade and growth. If it kept deficits, people might stop trusting the dollar, risking a financial crisis. Today, the dilemma still exists but in a different form. Instead of gold backing the currency, the dollar is fiat money, which means it is not backed by gold but by government trust. The United States still needs to supply dollars to support global trade. But doing so can push up inflation at home because more dollars in circulation can lead to rising prices. At the same time, global demand for dollars might not match the United States' economic situation or trade balance. This makes it harder for the country to control inflation without causing global problems. This situation shows how important global cooperation is. Countries need to work together to manage the supply of reserve currencies and avoid conflicts between domestic goals and international needs. Without coordination, the main reserve currency country might focus only on controlling inflation or boosting its economy, which could cause instability worldwide. The Triffin dilemma highlights a fundamental challenge in global monetary policy. The country issuing the main reserve currency must supply enough money to support international trade, but this can weaken confidence in that currency and make inflation control more difficult. It's a puzzle that continues to shape how countries work together to keep the international financial system stable.